Hey everybody, Economic Analyst back here. Today I'm going to go over the Producer Price Index report for November 2021 that came out yesterday. So producer prices pushed up once again from the previous month. This time the annual rate has increased to 22.8%. And on a month-over-month basis, the rate of change was about 1.4%. When we take a look at the producer prices with the rate of change over the past, since we came out of the pandemic with COVID, we're seeing that the average rate of change and the median rate of change put together is about 1.4%. So that's been largely in line with the historical precedent of the PPI increases that I've been noticing and have been looking at the trends on. And when we take a look here, unfortunately, a lot of this change is going and building on in the earlier stages of production in the producer price index. So it's in, when we look at the intermediate demand by production flow, stages 1 and 2, there are 4 stages that the producer price index measures. Stages 1 and 2 are the earliest stages of producer prices. We're seeing the jump in the month here at the highest of 1.5 and 2.5% in the earlier stages. And what that means is that those jumps will facilitate down to stages 3 and 4 and then down to final demand as time goes on. So if we were seeing these changes happen in final demand and or in the later stages of intermediate demand, then an argument could be made that we're seeing the peaking of inflation and that we don't have much longer to go before it filters out into the CPI. But the fact that we're seeing these month-over-month increases in the earlier stages means that what we're seeing in price inflation is still continual building. And this is really evidenced here in unprocessed goods. Look at that month-over-month change in unprocessed goods. 5% in 1 month. That's enormous because it first goes from unprocessed goods to processed goods. And, you know, the processed goods change was high, certainly 1.5, but this unprocessed goods, those earlier raw materials and things, those are really, really going up. Now, we're seeing some trending going up in services, you know, but we're not really seeing the changes as far as goods price inflation. So a lot of this is still contained in that goods price inflation. And no doubt a good significant portion of this inflation rate does have to do with the shortages of goods that we've been seeing for the past 6 to 7 months. But as I've said before we can just pass that off and just blame COVID and government shutdowns for everything, yeah, the government shutting down certainly restricted supply, but it's that increased demand that's helped facilitate those goods shortages. A lot of the service industries have been shut down, and so that's why we're not seeing prices increase so much for them, because the demand for those services has dropped, because sometimes they're just not available. So it's been shifting to actual goods, and we're seeing a huge rise in goods price inflation. Final demand inflation increased by 0.8% in 1 month. So that's a very, very high change in final demand. Certainly in line with what we were seeing in the earlier months, but we were seeing a little bit of cooling down in final demand changes for August, September, and October. Now it's heated right back up with that 0.8%. That brings final demand year-over-year inflation pushing 10%. It's at 9.7% on a seasonally adjusted basis. And when we take a look at the average and median that we for final demand prices, we're looking at 10%, over 10% price inflation for final demand going into 2022. So that's very, very high. And as I've said before, there's a strong correlation between the producer price index of final demand and the consumer price index. So if we're seeing 10% price inflation on final demand, a lot of that is going to come into the CPI. And now part of that, though, part of that has to do with the fact that during the COVID breakout of early 2020, final demand prices did fall below the CPI level. So they dropped more than the CPI, so it makes sense that they're increasing more than the CPI now. Nevertheless, the trend is holding clear there, that we're beginning to see these high increases in final demand facilitate out into the CPI. Now, looking at the final demand model that I have accumulated here, on the average, it looks like that we're going to see another 0.7% jump in the CPI, which would bring the annualized consumer price index report to 7.3% inflation here. So we're going to be well over 7% if we hit this 0.7%. Now, granted, the model is, plus or minus 0.5% on a monthly basis, but it has been my sneaky suspicion here that once again, we're probably going to see an underperformance on the model, and it understates the actual CPI inflation rate for December. More than likely due to increased consumption combined with supply shortages and record money printing that's still been going on, and debt accumulation. And because it's Christmas, everybody's buying goods. We're more than likely going to see that overperform at 0.9, maybe even 1% inflation, but I would say maybe on a guesstimate, probably a 0.9% month-over-month inflation rate. So that 7.3% is actually going to be 7.5%. And once again, it's because we still have some catching up to do in the CPI index back up to final demand. It's been underperforming a little bit. It'll probably catch up to about 98.5% or so, and that'll probably register with a 0.2% increase. So definitely looking at that inflation rate going in, which means that the consumer price inflation report will be at 7.5%, could be even a little bit higher by year's end. And going into 2022, that's going to be the headwinds that is going to be against our economy on that. So the outlook here is obviously, well, when is all this going to stop? When is the calming down going to commence, right? And that's really been the question here. That's anybody's guess. But as I've said before, it all stems back to that money supply growth rate. The Fed just came out and announced today from Jerome Powell that they're going to step up asset purchases. Now they're stepping up of stepping down or tapering down the asset purchases, not stepping up, but they're stepping up the tapering down of asset purchases here. That stepping up the tapering down there will certainly help slow some of that money supply increase. But unfortunately here, due to the huge amounts and glut of reserves that have been building up inside of the Federal Reserve, stocked away by the banks due to all the assets that they have purchased, it's going to take some time for that money supply to tamp down. Because if there's still a huge demand for loans right now, when we take a look at total reserves that are held at the Fed right now, clearly here it's over $4 trillion. Over half of the Fed's assets is just in bank reserves right there. So even if there's a drawdown on reserves due to excess demand for borrowing credit, it's not going to put immediate pressure on interest rates, certainly not on the short end, until these reserves draw down. And I don't know how low they would have to go for that to have an impact for us to really see it. But my guess is that those reserves will need to draw down below, say, $2 trillion, maybe just below $3 trillion, before we start seeing the effects that it has on interest rates. So essentially speaking, there's a lot of fuel, there's a lot of wood under the fire there that still has to burn, and that's in these reserves. So the Fed has made sure to backstop these banks with so much reserves to prevent another liquidity crisis that they've seen in November 2019, that unfortunately, if they taper back on their asset purchases, it's really not going to taper down on credit creation. I mean, it might taper down a little bit on money supply growth, but not really when we consider that, credit creation is still going to facilitate out through these banks that are trying to churn out loans in order to make a profit on. So, we're going to see this price inflation go out. Another real threat that we have is the re-convergence between the producer price index and the consumer price index right now. So that's a huge, huge problem. It's now approaching 90%. The producer price index is approaching 90% of the consumer price index report. And in case if you're wondering where I'm going with this, I made a video a while back showing that up until the 1980s, there was a strong correlation between producer prices and consumer prices. And then once with the onset of technology and the new types of innovations for cost cutting and low oil prices with increased oil production, that sort of kept producer prices low, even though consumer prices built pretty steadily right now. And then up in 2008, we started to see where producer prices were beginning to catch back up to consumer prices, getting over that 90% threshold, about 92 to 93% of consumer prices. And you can see in that little bump there in 2008 how we were starting to see that its effect on the consumer price index. It was starting to really begin to push up that index. And we're seeing that now where you can see the upward trend in that consumer price index. It's always been my belief that once we see producer prices reconverge with that consumer price index, it's going to continuously push it up, which means that we're no longer going to see 7 to 8% consumer price inflation. We're actually going to be seeing 10 or 15 or 20% price inflation, depending on how high producer prices go. So for the last 30 years, the U.S. economy has sort of enjoyed low producer price expenses, which has kept consumer prices tame, even though monetary inflation was still setting up. And that mechanism could break down in the next coming year or so if we see this catch up. So there's probably, my opinion is that what the Fed is doing, although they're ramping up the tapering down of asset purchases from $15 billion a month to $30 billion a month, my guess is that without some raises of short-term interest rates, that's not going to do much to quell the inflation syndrome that we're going on right now. So definitely some problems that are manifesting. I'm going to keep an eye on this, and I've got a lot more videos that I'm going to produce about our economy in general. I know I've been harping a lot on inflation lately, but we're beginning to see the shift here where we're going to move away from the inflation problem, because now that's been delivered, although I'm still going to keep doing monthly analyses on the consumer price index and producer price index. The real problem is going to be the debt and how much our economy can sustain that in the wake of rising interest rates. So stay tuned for that. I'm going to produce that shortly, as well as several other videos. I've been keeping an eye on things, so you'll be seeing those coming out in the next days leading up to Christmas, and then after a short break, I'll get back to it after Christmas. So guys, I thank you for watching this video. If you like the content that I produce, make sure you just click that like button and show me some support. Subscribe to my channel if you haven't already, and click that notification bell. You'll always be notified whenever I do produce a new video. They're going to come out pretty regularly now because there's a lot of things to go into, a lot of things to project outwards for 2022. And at this channel, it's my job and my duty that I feel to inform you as much as possible on the situation that's been developing in our economy. So once again, guys, thank you for watching this video, and I'll talk to you later.